I'm Matt Bishard in San Francisco for NAREIT's REIT World, our 2018 annual conference. Joining me today is Jim Taylor, President and CEO of Brixmor Property Group. Jim, thanks so much for joining us.
Thank you for having me.
Now, how have efforts to dispose of your non-core assets proceeded in 2018, and how are they positioning the company for 2019 and beyond?
Well, thank you. They've gone exceptionally well. In fact, we have exceeded the volume that we expected to transact this year by about 30 to 40%, as we've found a really strong private bid for the types of assets that we own. Of course, what we've focused on from a sale perspective are those assets that are in the bottom quartile of our portfolio as it relates to anchor sales productivity, rents, demography, et cetera. And so having sold almost 15% of the company over the last 18 months through the private markets, it really does position the balance of our portfolio to grow on a more consistent and sustainable basis. So we're excited about how it positions us. We've obviously done a lot of work also on the balance sheet to bring down leverage, which puts us in a position going forward to be much more balanced. I think capital recycling is always part of a good long-term plan in terms of pruning. But it allows us, as we look forward, given all the success we've had this year, to be much more balanced and opportunistic.
Now, what level of demand are you seeing in the open-air shopping center sector, and how is that translating into leasing activity?
You'd never believe it, but demand's never been better. I think, despite what the general headlines are saying, the retailers who are thriving in this environment are looking to grow their bricks and mortar presence, looking to relocate stores as well as they try to get the format to serve the customer. We're the largest landlord to Kroger, we're the largest landlord to TJ Maxx. And in addition to those concepts in specialty grocery, fitness, restaurants, we're seeing really a wide range of demand for retailers to be in open-air locations, really to connect with their customer. So it's showing up in our leasing. And if you look at the volume of leasing that we're doing and the spreads, frankly, that we're achieving, it demonstrates that tenant demand to be in our shopping centers. So it's been great. And that, in addition to the capital recycling we just discussed, really does set us up well for growth as we look into 19 and beyond.
Now, lastly, where is the company's current balance between acquisitions and redevelopment, and do you see that sort of mix shifting anytime going forward?
The returns that we can find reinvesting in assets that we own today through reinvestment or redevelopment are quite attractive. You know, we're achieving returns of 9 to 10 to 11% on an incremental basis. In fact, today we have over $340 million of reinvestment projects underway. So that really is the most attractive use. As we think about acquisitions, it's really part of a capital recycling strategy. And we will look to acquire assets that are in the same markets and retail nodes where we currently have a presence. And what's important about that is, from an underwriting perspective, we're not relying on third parties. We're already operating in that market. So the risk-adjusted profile of making that capital decision is much more manageable. But again, on balance, when you think about the returns that you can get in an acquisition versus what might be available making your asset better, it's the reinvestment and redevelopment that's drawing most of our focus.
Jim, thank you so much for joining us.
Thank you for having me.
For more from REIT World 2018, be sure to visit NAREIT's website, REIT.com.